Welcome back to your latest episode of Tax Problem Solved. I'm your host, Deltrice Hart Anderson, and I am keeping the IRS out of your pocketbooks, wallets, and bank accounts. In today's episode, we're breaking down how some of the newest tax changes and some misunderstood old rules the IRS is now enforcing harder are creating brand new tax trouble for everyday taxpayers. So I'm calling this episode New Tax Law, New Tax Trouble. We're going to focus on 5 big areas where I'm already seeing some confusion out in these social media streets. So let's get into it. So the first thing I want to talk about is that standard deduction. Yes, the standard deduction went up, okay? No, that does not guarantee that you're going to get a refund because the standard deduction increased. So here's how people get hemmed up, if you will. You may assume higher deduction equals refund or lower taxes, but don't forget the tax brackets have been adjusted. The withholding tables did not keep up with those adjustments, okay? Inflation, everything's gone up, right? So inflation pushed many people into higher income tax brackets. Then you have people that had side hustles and gig work and real estate that just did well, okay? Those weren't in last year's tax plan. So you have to think about all of that. I'm seeing a lot of people looking at me shocked when I tell them when I'm doing these tax plans that, oh, your tax liability is still going up. What about the new tax laws? People are asking me. Some of those tax laws don't apply to you. So don't get too comfortable. The trouble is not the deduction, guys. The trouble is the misunderstanding of the deduction. Okay? Let's talk about that new child tax credit. It's a small change, but it's so much confusion around that small change. That child tax credit was boosted to $2,200 per child, right? So a parent may assume that just because you have a child, you will automatically get the credit. That is not necessarily so. You have more families that are earning more wages and salaries. So they're hitting the phase outs. Extra income from raises or second jobs. Again, your real estate is doing well. That's pushing you over the limit to actually get that whole $2,200 per child, or even get the $2,200 at all. Okay. The refundable portion is different depending on your income. Okay. I even see where part year residents are losing eligibility. So, all of that is something to think about. If your income increased at all, even if it increased by $1,000, your credit might be reduced, or you may not even get the child tax credit. Okay. So, don't base your refund or your tax savings off of last year's results. I know I'm going to botch this up, but I always hear the saying out here now, today's prices aren't yesterday's prices. Well, today's tax return is not yesterday's tax return, okay? This year, your tax return could be different. To my restaurant people, my service industry people, I know you're hearing out in these social media streets, oh, there's a new law, no tax on tips. Well, here's the thing, that is partially true. It's no tax on tips up to 25,000, but if your adjusted gross income is over 150,000, then that doesn't even apply to you. Okay? Tip income has always been taxable. All right? But this year, the IRS rolled out stronger tracking for the service industry workers. So here's how people get in tax trouble. This is the new stuff. There are going to be more payment apps that are reporting more stuff. There are tracking systems. So your employer will have tracking systems that's going to track the cash versus the card tips. Okay. So just keep that in mind. Restaurants, they're under a new tip reporting compliance, and there are some initiatives around that. Restaurant owners, if you're listening, you need to get with your tax professional about the tip reporting compliance. Okay. Automated matching is going to catch up with underreported income. What does that mean? That means that all of the new compliance that the IRS has imposed on the restaurant owners to make sure that the tips are included accurately on the W 2 forms. If you, as a service industry worker, report something different from what your employer has reported to the IRS, guess what? Expect a CP 2000 notice. And with that, if it's ignored or if the IRS is right and you're wrong, there will be penalties and interest. Okay. This is going to catch a lot of taxpayers off guard. Don't you be one of them. Okay. So, again, my service industry workers, bartenders, wait staff, even hairstylists, rideshare drivers. Okay. Just don't get hemmed up by these new tax law changes. I'm going to talk about the overtime as well as the car loan interest. But let me start with the overtime. The overtime can bump your income up, right? And it could even take you into a higher tax bracket. So when you hear out in these social media streets, oh, there's no taxes on overtime, that's only partially true because there are limits to that. What people don't realize is your employer is not adjusting your withholding, that W 4 form. They're not adjusting for that overtime. Okay. Extra income means you need to withhold extra money. All right. You need to make sure the overtime rules, the new tax law rules, apply to you. More overtime means more money, and it could be that it means more taxes owed. And then the next is that car loan interest. I know you're hearing out in these social media streets, if you buy a car, then the car loan interest is going to be deductible. So people are still trying to deduct car loan interest like it's a mortgage payment. It's not. Car loan interest, okay, is going to be different. Some people are thinking, oh, if I buy a new car, I thought I could write off the car payment. No, IRS is not giving you credit for the car payment itself. And they're not even really giving you a whole lot of credit for the car loan interest. Go out there buying no new car and thinking that you're going to have this big write off because you're not going to. It's just not going to work that way. So don't let these people out in these social media streets fool you to go out there and buy yourself a brand new car or a used car or something that you can't even get a deduction for. But even if you are able to get a deduction, go Go do a tax assessment, a tax plan, a tax strategy, whatever you want to call it, with a professional. Because what I don't want you to do is go out here and purchase this $30,000, $40,000 car, and now you have a $500, $600 car payment a month, but your deduction for this loan or the interest on the loan ends up being $200 or $300. Now you've spent seven, eight, $9,000 a year to get a $200 or $300 deduction. Don't do that. Please don't do that. My seniors out there, yes, there is a new tax law that may apply to a lot of seniors, but you have to look at your income. That there's an extra deduction for seniors up to $6,000. You have to look at your tax situation. You have to look at the amount of money that you make, okay? You have to look at, are you married? Are you married filing joint? Are you married filing separate? Are you single? How much money are you reporting, and from what income sources? Are you reporting from your Social Security? You might have a retirement or pension. You might have drawn money out of a retirement account that may be taxable to you for whatever reason. You might have a required minimum distribution. You may also have had a side hustle. So all these things, don't think that that extra deduction is a free for all, okay? Get with someone that could actually help you plan to determine whether these new tax laws apply to you. Again, we want these new tax laws to be applicable. We don't want them to cause new tax trouble. So here's the mindset I want you all to have, okay? I want you to, even though, yes, there are new tax laws, I want you to get with a professional that can actually sit down with you to explain to you how the tax laws work with you and your financial situation, your tax life, not someone else's, okay? Stop listening to the sound bites that you hear in social media streets about the new tax rules. All of them will not apply to you. Some of them could, but you have to be certain before you start making these money moves that won't help you at all. Okay. There's a lot of these areas, especially with the child tax credit, the tip income, the overtime, the car loan, all these things, they're going to generate a lot of IRS letters next year. Trust me, every time there's a new tax law, that's what happens. A lot of misunderstanding because people hear the sound bites in these social media streets. It's not because you want to do the wrong thing, it's because you don't understand the new rules or the way the IRS is enforcing these rules, okay? And that's where a professional comes in. Now, most of the times I'm on here talking about get yourself an IRS enrolled agent, a CPA, or an attorney. But now I'm telling you, yes, you can get with the IRS enrolled agent. Yes, you can get with the CPA. Don't bother going to an attorney because this is not their wheelhouse unless they are tax preparers as well. Okay. But you can also get with a reputable tax professional that has a P10 and that understands the tax laws and how to assist you with tax planning and tax strategies when it comes to the tax laws. Everything out here ain't for everybody. You just have to figure out what is right for you so these new tax laws won't end you up in new tax trouble. That's all I have for you guys today. Thank you so much for listening. If you need any assistance in understanding the tax laws, reach out to me. I know tax professionals in almost every state. So if I can't assist you and point you in the right direction, I'm going to call someone that is going to be able to assist you or point you in the right direction. Okay. Again, that's all I have for you today. I'm Deltrice Hart Anderson, keeping the IRS out of the pocketbooks, wallets, and bank accounts of taxpayers. Till next time, bye, y'all.